So in this video, we are going to look at the self-review threats. And we say the self-review threats arise when an auditor cannot evaluate his or her personal work or that of the member of the team. So we have very many self-review threats. And the formula we are going to use here is Spirit VP, whereby S is for serving as a director or officer of a client. We are going to look at the explanation in the later in this video. Then P is for provision of non-assurance services. Non-assurance services are those services that are not auditing services, that do not give assurance to the client, like filing for tax returns, things like that, management advice and consultation. So provision of non-assurance services generally. Then I is for IT system services. R is for recent service of an audit client. Then I is for internal audit services. T is for taxation services. Another T is for temporary staff assignments. V is for valuation services. And then P is for preparing financial statements. So the formula is Spirit VP. Yeah. So we are going to look at each of them. We look at the threat, its effect, and then the safeguard. So we shall start with recent service with an audit client as a director, officer, or an employee. Like if you've been working, we are using the same example. Let me say the client is MTN and the audit firm is KPMG. If you were working with MTN not long ago, maybe as a director, an officer, or an employee, but now you shifted from MTN to KPMG. So now it happens that maybe after 6 months, you are supposed to go and audit MTN where you were working 6 months ago. So you may not objectively evaluate the financial statements or do what you are supposed to do because you already know what goes around in that company. Things like that. Yeah, you might even find that you did some of the work that you're going to evaluate. So you may not be able to evaluate your own work that you did. I hope you get that. So the threat is recent service with an audit client as a director, officer, or an employee. So the effect is work done may not be objectively evaluated during a subsequent audit. Subsequent is like the following audit, during the following audit. So the safeguard here, like how you can avoid it, is that no auditor should audit a former employer unless 2 years have elapsed. So if it is 6 months, 1 year, 1 year and a half, you're not allowed to audit your former employer. So that person is not supposed to be on the team. Then review the work performed by the individual as a member of the audit team. You can get someone independent to go through what that person did. Yes, so those are the two safeguards. You review the work performed, then no auditor should audit a former employer unless 2 years have elapsed. Then the next threat is temporary staff assignments by an audit firm to an audit client for a short period. Like audit firms offer very many services. So maybe like 1 month before, MTN got some people from KPMG to do for them some work, maybe failing for returns, maybe giving them management advice, things like that, or to prepare financial statements. So temporary staff assignments by the audit firm to an audit client for a short period of time. So the employee may not objectively audit his or their own work in case they prepared financial statements or in case they gave management advice. So they will not be able to objectively audit their own work. Like in case they find a mistake in their own work, they will not point it out. So they might end up giving a subjective opinion instead of an objective one. That is the effect. Then the safeguards. The first one is additional review of the work performed by the loan staff, that staff that performed that temporary work. You get additional review, like you get someone else to go through what they have done. Then the loan staff should not be allocated the audit work performed during the temporary assignments. Like in case maybe they prepared financial statements, in case maybe they prepared a cash flow statement, they should not be the same people to evaluate the cash flow statement. So they should not be allocated the audit work performed during temporary assignments. They should not evaluate what they did. Then another safeguard is that the loan staff should not be included in the team. If you can avoid it, do not include those that were working with the company before. Yeah, those people who were working on temporary assignments with MTN should not be included in the audit team to avoid self review threats. Yeah, so those are the safeguards to temporary staff assignments. Additional review then should not be allocated the work that they performed or should not be included in the audit team. Oh, another one is that the staff should not assume management responsibilities. Because in an organization that we are going to see the management responsibilities. Yes, and then the responsibilities of the auditor. So staff should not assume management responsibilities. Then another threat we have is serving as a director or officer of the audit client. Like if you are working with KPMG and MTN at the same time, so you are serving as a director or officer of the audit client. So the effect is close association with the entity may impair your objectivity since you are working with MTN. You wouldn't want to piss them off because you might lose your job. So close association with the entity may impair your objectivity and you might end up giving a wrong opinion. Then the safeguard is no partner or employee of an audit firm should serve as a director or officer of an audit client. Sorry, not audit firm here, of an audit client. Allow me edit it. Yeah, so no partner or employee of an audit firm should serve as a director or officer of an audit client. You should not work in both organizations at the same time. Yeah. Then another one we have is provision of non-assurance services to audit clients generally. Yeah, the non-assurance services, we have many. We looked at them in topic 1. Yeah. We have the taxation services, then management and consultancy, those ones. So provision of non-assurance services. If you're the one giving advice to if KPMG is the one giving advice to MTN, so the firm becomes too aligned with the interests of management. So it means that they already know what the other people are doing and they cannot say anything bad about it, because like they are the same people that are advising them or helping them with whatever they're doing. So they may not give the right opinion just because they're helping them with managing their company, something like that. So provision of non-assurance services to audit clients, yeah, it will impair the objectivity of the auditor. So how can you protect yourself from this? First is that an auditor should not provide non-assurance services to an audit client if it compromises your objectivity. If you know that you will not be able to give the right opinion in case you offer other services to that client, you shouldn't offer those services. So an audit firm should not provide non-assurance services to an audit client if it compromises their objectivity. Then secondly is that an audit firm should not assume management responsibility for an audit client. They should not assume management responsibility. Into brackets C note A, we shall see what note A says. Yeah, it's about management responsibility. We are going to look at what management is supposed to do and what the auditor is supposed to do. So the audit firm should not assume management responsibility to avoid colliding. Then another threat is preparing accounting records and financial statements. Like in case KPMG is it is the auditor for MTN. At the same time, it prepares the books of accounts and then the financial statements for MTN. So if there are people that prepare the financial statements and then you bring them to evaluate the financial statements, they will not be able to evaluate their own work. Even when they find an error, they will not be able to point it out because they did it themselves. So the effect is the same auditor may not easily identify errors in his or her own work. Yeah, they may not see it, or even when they see it, they may not point it out. Yeah. Then the safeguard, how to avoid this: using staff other than the audit team members to carry out the work. Then, like instead of using KPMG to prepare the books of accounts and prepare financial statements, you should instead use your own staff, MTN staff, to prepare the financial statements and keep the books of accounts. Then another safeguard is using an independent partner or senior staff member who is not part of the audit team to review the work performed. So you can get someone else who was not on the audit team to come and review the work or revise the work that has been performed by the audit team of KPMG. Then another safeguard is this: an audit firm is not allowed to offer such services to an audit client that is not a public interest entity. So KPMG is not allowed to prepare financial statements for MTN and keep their books of accounts in case MTN is not a public interest entity, except in emergency situations where it is impractical for the audit client to make other arrangements, except whereby it's an emergency and MTN cannot get like those services from anywhere else. And in Note B, we shall be seeing the emergency situations. Yeah, so those are the two safeguards. 2, 3, like you use your staff to keep the books and prepare financial statements. Then you get the independent partner to review the work performed. Then an audit firm is not allowed to offer such services to an audit client that is not a public interest entity, except in emergency situations. We shall look at the emergency situations. Then another threat is valuation services for an audit client. Valuation is mainly for property, plant, and equipment, the fixed assets. You value, like you determine their value at the moment. So if you offer valuation services for an audit client, it impairs objectivity during the audit of financial statements. Yeah, because valuation, you might give wrong values. Yeah, but when like you are the same person that valued those assets, then they bring you back to evaluate the financial statements. Remember, the fixed assets are included in the statement of financial position or balance sheet. So if MTN used KPMG to value their assets, and at the same time they bring back KPMG to evaluate the financial statements, they may not give the right opinion, or they may not be objective in their work, since they were the same people that valued the assets. Yeah, and they may not be able to find errors in their own work. So the safeguard here is that an audit firm should not provide valuation services to an audit client if valuation has material effect on the financial statements. So they should not provide valuation services to an audit client. KPMG should not provide valuation services to MTN if what they're valuing has material effect on the financial statements. We shall be looking at materiality in topic 3. Yeah, what is considered material and what is immaterial. Yeah, so that is the safeguard. Then another threat is taxation services like tax planning and handling tax disputes with URA. Like in case KPMG is helping MTN with taxation services, like to plan for their taxes and then solving their tax disputes with the Uganda Revenue Authority. So this will impair their objectivity as tax is included in financial statements to be audited by the same firm. So since they're the same people that are offering the taxation services and tax is included in the financial statements, they may not be able to find errors in their own work. And even when they find, they may not be able to point it out.